You believe you know your tax rate. You see it deducted from your paycheck. You file your return every April. You assume the government takes its share openly and through legal channels. Wrong. The visible taxes you pay represent a fraction of what governments extract from you. For 2,000 years, states have operated a parallel system of wealth transfer, one with no line items, no receipts, no legislative votes. The money leaves your pocket in ways you never see and never authorized. This is not speculation. This is documented in Roman mint records, Federal Reserve archives, Treasury Department memos, and Congressional Budget Office studies. The paper trail exists. You were never shown it. Currency debasement, financial repression, inflation taxation, bracket creep. These terms sound technical. They should sound like theft. The machinery of extraction operates through bottlenecks you cannot avoid: currency itself, interest rates, tax brackets. The structural architecture of money flows through government-controlled pressure points before it reaches you, after it leaves you, and while it sits in your account. These systems were engineered across centuries by finance ministers, central bankers, and treasury officials who understood a simple truth. Visible taxes create resistance. Hidden taxes create revenue. The infrastructure of modern money gives governments leverage over every transaction, every savings account, every retirement fund. You are not a citizen in this system. You are a resource. And resource extraction follows predictable patterns, documented across empires, across centuries, across continents. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. Right now, your savings account pays you less than inflation takes. Your tax bracket creeps higher without any congressional action. Your dollars buy less each year. These are not economic accidents. These are the same documented strategies Roman emperors deployed in 200 CE, Franklin Roosevelt activated in 1933, and Richard Nixon implemented in 1971. The playbook has not changed. The techniques have grown more sophisticated. And by the end of this video, you will see exactly how the system works, where the documentation exists, and why your financial future depends on understanding what they never taught you in any economics class. This is a 2,000-year story of governments solving their money problems by creating yours. The Roman denarius began as a promise. Under Emperor Augustus in 27 BCE, the coin contained 95% pure silver. When a Roman legionnaire received his pay, when a merchant closed a sale, when a citizen paid taxes, the denarius represented real value backed by precious metal. The Roman state made an implicit contract with its people. This currency holds worth. That contract had a shelf life of about 250 years. Metallurgical analysis of Roman coins tells a story the ancient historians only hinted at. Scientists have extracted thousands of denarii from archaeological sites across the former empire. They have tested the silver content with modern spectrometry. The results reveal the longest-running currency fraud in human history. By 64 CE, under Nero, the silver content dropped to 94%, a small reduction, barely noticeable. By 100 CE, the purity fell to 85%. By 150 CE, down to 75%. The decline accelerated through the 3rd century. Under Septimius Severus, around 200 CE, the coins contained about 50% silver. Under Gallienus, in 260 CE, the purity collapsed to 5%. By the time Claudius II ruled in 268 CE, the denarius was a bronze coin with a thin silver wash. The Roman government did not announce these changes. No emperor stood before the Senate and declared a currency devaluation. The mint simply began mixing more copper and less silver into each coin. Same size, same stamp, same face value, less worth. The mechanism was elegant in its deception. The government paid its obligations, primarily military salaries and construction projects, in newly minted debased coins. Soldiers received payment that looked identical to older money. The state then collected taxes, often demanding payment in older, purer coins or at rates that did not account for the debasement. The wealth transfer was invisible to most citizens until the cumulative effect crashed the economy. We know the consequences from contemporary sources. Diocletian's edict on maximum prices from 301 CE attempted to control an inflation spiral that had made ordinary commerce impossible. The edict lists prices for over 1,000 goods and services. Comparison with earlier price records shows increases of several 100% over the preceding decades. Wheat that cost half a denarius per measure under Augustus cost 100 denarii by 300 CE. The historian Cassius Dio, writing in the early 3rd century, documented the economic chaos. He described soldiers rioting over worthless pay. He recorded merchants refusing to sell goods for official currency. He noted the government's awareness of what it had done. This was not ignorance. Roman treasury officials understood the relationship between money supply and prices. They chose debasement because the alternative, raising taxes openly, sparked immediate resistance. The currency approach worked slowly. It distributed the pain across years. It obscured the source of impoverishment. The Roman state effectively defaulted on every obligation it owed while maintaining the legal fiction of payment. A veteran who served 20 years and retired with a promised pension received coins worth a tenth of their original value. A bondholder who loaned money to the state got repaid in diluted currency. The government kept its technical promises while breaking its real ones. Consider what this meant for an ordinary Roman family. Your grandfather earned and saved in silver denarii containing real precious metal. Your father earned in debased coins worth less than face value. You earn in bronze tokens with a silver coating, 3 generations of wealth extraction through the currency itself. No tax collector visited your home for this particular theft. The mint handled everything. The pattern repeated across every major currency crisis in history. The mechanism requires 3 elements: government control of money creation, fiscal pressure exceeding tax capacity, and a population without alternative currency options. Rome had all 3. So does every modern nation. When the Roman system finally collapsed in the 3rd century crisis, the state had extracted centuries of accumulated citizen wealth through the monetary system. The empire survived by reinventing its economy under Diocletian and Constantine, but the lesson embedded itself into the institutional memory of every treasury that followed. You want money to solve a fiscal crisis without raising visible taxes. Debase the currency. The people will feel poorer over time, but they will not connect their poverty to your policy. By the time they understand, a generation of wealth has already transferred. The Romans wrote the manual. Every government since has read it. On April 5, 1933, President Franklin Delano Roosevelt signed Executive Order 6102. The document required all American citizens to surrender their gold coins, gold bullion, and gold certificates to the Federal Reserve. Failure to comply carried a penalty of up to 10 years in prison and a fine of $10,000. The government paid citizens $20.67 per ounce for their gold. 1 year later, the Gold Reserve Act of 1934 revalued gold to $35 per ounce. In the space of 12 months, the United States government confiscated gold from its citizens at one price and immediately raised the official value by 69%. The mathematics of this transaction require no interpretation. A citizen who surrendered 100 ounces of gold in 1933 received $2,067. That same gold was now worth $3,500. The government captured the $1,433 difference. Multiply this across millions of ounces, and you have the largest single wealth transfer in American history to that point. Treasury records document the scale. Government gold holdings increased from approximately $4 billion to $7.4 billion. The difference came directly from American pockets. The official justification was the Great Depression. The government claimed it needed gold to expand the money supply and stimulate the economy. The technical arguments filled pages of policy documents. The practical reality was simpler. The United States government faced fiscal pressure. It needed money. It took gold from citizens and gave them paper. The order contained specific exemptions designed to ease passage. Dentists could keep gold for professional use. Jewelers retained allowances. Citizens could keep up to $100 worth, about 5 ounces. These exemptions created the appearance of moderation while the bulk of monetary gold flowed to government vaults. Enforcement varied across the country. Some Americans complied immediately, trusting their government in a time of crisis. Others hid gold in walls, buried it in yards, moved it to foreign banks. The government pursued high-profile prosecutions to encourage compliance. Frederick Barber Campbell spent years in legal battles after refusing to surrender his gold. The cases made newspapers and the message spread. The paper dollars citizens received in exchange for their gold had their value tied to a promise. The government would maintain the dollar's purchasing power. That promise lasted exactly 1 year before the same government devalued those dollars by 69% against gold. Trace the incentives in this system. The government owed debts in dollars. It faced ongoing Depression-era expenses. By devaluing the dollar against gold, every debt the government owed shrunk in real terms. Every bondholder got repaid in cheaper dollars. Every pension obligation became more affordable. The beneficiary was the state. The losers were citizens holding dollars and those who surrendered gold. Modern economists debate whether FDR's gold policy helped end the Depression. The academic arguments continue, but the wealth transfer requires no debate. It is arithmetic. The documents exist in the National Archives. The executive order carries Roosevelt's signature. The Gold Reserve Act passed Congress with recorded votes. This was policy, not accident. What strikes the modern reader is the speed and totality of the action. On April 4th, 1933, American citizens had a constitutional right to own gold. On April 6th, they faced federal prosecution for the same act. No referendum, no extended public debate. An executive order transformed legal property into contraband overnight. The government justified emergency powers through emergency conditions. The Depression provided cover for actions that would have sparked revolution in ordinary times. Citizens surrendered gold because they believed the sacrifice would restore prosperity. Many did not realize the surrender was permanent. Gold ownership remained illegal for American citizens until 1974. 41 years passed before you could legally hold monetary gold in the United States. During those decades, the dollar lost value continuously against gold and against goods. A citizen who surrendered gold in 1933 and received dollars watched those dollars decline in purchasing power year after year. The lesson from 1933 is direct. Governments facing fiscal pressure will take private wealth through legal mechanisms. They will justify the taking with crisis language. They will use the legal system to enforce compliance. And they will time the taking to precede the devaluation, capturing the spread between confiscation price and new valuation. Roosevelt's Treasury Secretary, Henry Morgenthau, kept detailed diaries throughout the administration. His entries reveal an understanding of the policy's effects. The government knew it was transferring wealth from citizens to the state. Officials believed the transfer served a greater good. The citizens who lost their gold were not consulted about this moral calculation. August 15, 1971, a Sunday evening. President Richard Nixon interrupted regular television programming with an economic address. The speech contained technical language about international monetary arrangements. Most Americans did not understand the implications. Well, they should have. Nixon announced that the United States would no longer convert dollars to gold for foreign governments. The Bretton Woods system, which had anchored global currencies to a dollar backed by gold since 1944, ended with a presidential address. Treasury Secretary John Connally summarized the American position in a private meeting with European finance ministers. His words were recorded for history. The dollar is our currency, but it is your problem. This statement captures the entire system of monetary extraction that followed. The United States would print dollars to meet its needs. The rest of the world, holding dollars as reserve currency, would absorb the inflationary consequences. American fiscal problems became everyone's inflation. The Nixon archives contain the internal deliberations. Presidential recordings capture conversations between Nixon, Connally, and Federal Reserve Chairman Arthur Burns. The transcripts reveal that administration officials understood the inflationary implications of their decision. They chose to proceed because the alternative, fiscal discipline or gold outflows that would constrain spending, was politically unacceptable. The immediate cause was a run on American gold reserves. Foreign governments, particularly France, had been exchanging their dollar holdings for gold at the official rate of $35 per ounce. They recognized that the United States had printed far more dollars than its gold reserves could support. They wanted the metal before the inevitable adjustment. Nixon faced a choice. He could let gold reserves drain until the dollar's convertibility became meaningless. He could raise the gold price dramatically, acknowledging the debasement that had already occurred. Or he could end convertibility entirely, freeing the government to print money without the constraint of gold backing. He chose the third option. The immediate aftermath included wage and price controls, an attempt to suppress the inflation that Nixon knew would follow. The controls failed within 3 years. By 1974, inflation exceeded 12%. The dollar lost purchasing power at rates not seen since the Civil War. What did this mean for ordinary Americans? Before August 1971, the dollar had a theoretical anchor. The government faced at least some constraint on money creation because foreign governments could demand gold. After August 1971, no constraint existed. The Federal Reserve could create unlimited dollars. The only limiting factor was political will. Political will proved weak. From 1971 to 2024, the M2 money supply grew from approximately $700 billion to over $21 trillion, a 30-fold increase. The dollar lost over 85% of its purchasing power during this period. These numbers come from Federal Reserve data, available to anyone who searches for them. The mechanism works through simple dilution. If $100 exist and you hold 10, you own 10% of the money supply. If the government creates $900 more, you now hold 10 of 1,000 or 1%. Your paper did not change. Your share of total purchasing power collapsed by 90%. Nixon's decision made this dilution permanent and unlimited. The gold standard had flaws, but it imposed some friction on government money creation. Removing the standard removed the friction. The beneficiaries of this system are predictable. The government, as the largest debtor, gains from inflation. Its debts are fixed in nominal terms. As dollars lose value, the real cost of repayment shrinks. $100 billion borrowed in 1971 becomes trivial to repay with $24. The losers are equally predictable. Anyone holding dollars, especially in savings accounts and fixed income investments, watches their wealth erode. Retirees on fixed pensions. Workers whose wages lag inflation. Savers who played by the rules and accumulated slowly. The Nixon administration knew this. The archives prove it. The recordings capture officials discussing the distributional effects of their policies. They proceeded anyway because the benefits accrued to the government and the costs dispersed across millions of citizens who would not understand the cause of their slow impoverishment. When you hear economists describe the end of Bretton Woods as a technical adjustment to monetary arrangements, remember Connolly's summary. The dollar became America's tool and everyone else's problem, including you. Between 1945 and 1980, governments in the United States and United Kingdom faced a challenge. World War II had left massive debts. The U.S. debt to GDP ratio exceeded 120%. Britain's situation was worse. Voters expected peacetime prosperity, not austerity. Open tax increases would end political careers. Treasury officials found another way. Economists Carmen Reinhart and M. Belen Sprancia published research in 2015 documenting what they called financial repression. Using Federal Reserve records, Treasury archives, and Bank of England data, they quantified a systematic wealth transfer from savers to government that operated for 35 years. The mechanism required two elements. First, governments kept interest rates artificially low through Federal Reserve policy and direct controls on bank lending rates. Second, inflation ran above those controlled interest rates. The combination meant that money saved in banks or invested in government bonds lost real purchasing power every year. Between 1945 and 1980, the average real interest rate on government debt was negative. This meant that after adjusting for inflation, bondholders received less purchasing power back than they lent. The government borrowed your money, returned it later, and the returned sum bought less than the original loan. Reinhart and Sprancia calculate that this mechanism reduced U.S. debt to GDP ratios by 3 to 4 percentage points annually. In Britain, the effect was even larger. Across both countries, over 3 decades, the total wealth transfer from savers to governments reached into the hundreds of billions of dollars in current value. Who lost in this system? Anyone with a savings account, anyone holding government bonds, pension funds invested in safe assets, insurance companies backing policies with conservative portfolios. The losers shared a common profile. They followed conventional financial advice, avoided speculation, and trusted their governments. Who won? The government, as the primary debtor, captured the entire benefit of the negative real rates. Politicians could claim to be fiscally responsible while inflation did the work of debt reduction. No legislator voted for this hidden tax. No campaign promised to expropriate savings. The mechanism operated through interest rate policy, invisible to most citizens. The policy was not accidental. Federal Reserve meeting transcripts from this period show officials discussing the need to keep rates below inflation to manage government debt. Treasury correspondence reveals awareness of the distributional effects. Policymakers understood they were transferring wealth from savers. They justified the transfer as necessary for macroeconomic stability and debt reduction. Consider the experience of a typical saver in 1960. You put $1,000 in a savings account paying 3% interest. At year end, you have $1,030. But inflation ran 4% that year. The purchasing power of your savings fell from $1,000 to approximately $990. You watched your account balance grow while your real wealth shrank. This happened every year for 35 years. The cumulative effect was devastating for conservative investors. A family that saved diligently through the 1950s, 1960s, and 1970s, earning passbook rates and holding government bonds, saw their purchasing power erode continuously. They followed every rule of prudent financial behavior. The system punished them for it. Meanwhile, borrowers thrived. Anyone who took on fixed-rate debt, especially mortgage debt, watched inflation reduce their burden. The house cost the same nominal amount, but the dollars used to repay the loan became cheaper each year. The government, as the largest borrower, benefited most of all. This was a wealth transfer from creditors to debtors, from savers to spenders, from citizens to government. The academic research documenting it uses neutral language. The policy implications are less neutral. Reinhart has described financial repression as a form of taxation that operates without legislation. The government extracts wealth through monetary policy rather than tax policy. The extraction appears nowhere on your tax return. It leaves no paper trail in your personal finances. You simply find that your savings buy less over time, and you attribute the loss to vague economic forces rather than deliberate policy. The strategy worked. By 1980, the World War II debt burden had become manageable. Mission accomplished. But the precedent remained. Governments had discovered that they could tax savings without voters noticing. That lesson shaped every monetary policy decision that followed. Your salary increases from $50,000 to $55,000. A 10% raise. You celebrate. Your employer values your work. Your career advances. Then you receive your first paycheck at the new salary and notice something strange. Your take-home pay increased by less than 10%. The government took a larger share of your raise than it took of your original salary. This is bracket creep. The Congressional Budget Office documented this phenomenon extensively between 1969 and 1985. Their studies show how inflation, combined with a progressive tax system, automatically raises effective tax rates without any congressional vote. The mechanism requires understanding marginal tax brackets. In a progressive system, your first dollars of income are taxed at a low rate. Additional dollars face higher rates as you move up the income scale. The boundaries between brackets are set at specific dollar amounts. When inflation raises all wages, workers move into higher brackets even without gaining real purchasing power. A family earning the median income in 1965 faced a marginal federal tax rate of 17%. By 1980, the same family, measured in real purchasing power, faced a marginal rate of 24%. Their real income had not increased, their tax burden had. The CBO calculated that bracket creep generated significant new revenue for the federal government every year of the 1970s. This revenue appeared without any legislation. No congressman voted for higher taxes. No president signed a tax increase. Inflation did the work automatically. The beneficiary was the federal government. Every year of inflation delivered a revenue windfall. Politicians could increase spending without casting difficult votes. They could blame inflation on external factors while capturing its fiscal benefits. The losers were taxpayers at every income level. Workers received nominal raises that did not keep pace with their rising tax burden. Families found that promotions and cost of living adjustments left them no better off after taxes. The treadmill ran faster, but the scenery never changed. In 1981, Congress finally indexed tax brackets to inflation. This reform, part of the Economic Recovery Tax Act, adjusted bracket thresholds each year to prevent automatic tax increases. The era of pure bracket creep ended in the United States, but the story did not end. Many elements of the tax code remained unindexed. The alternative minimum tax, originally designed to catch wealthy tax avoiders, increasingly hit middle-class families as its thresholds failed to keep pace with inflation. Social Security taxation thresholds remained frozen for decades, pulling more retirees into paying taxes on their benefits. Other countries never implemented indexing at all, or have suspended it strategically. The United Kingdom announced in 2022 that income tax thresholds would remain frozen through 2028. With inflation running above target, this policy guarantees bracket creep. The Office for Budget Responsibility projects that millions of British taxpayers will move into higher rate brackets through this mechanism, not through any wage increase in real terms. Treasury projections show the expected revenue gains. The government knows exactly how much money bracket creep will generate. Officials made a deliberate policy choice to capture this revenue rather than adjust thresholds. The decision appeared in no campaign platform. No party ran on a promise of stealth tax increases. The psychology of bracket creep favors governments. Citizens see their nominal wages rise and feel progress. They do not perform the inflation adjustment that would reveal the stagnation or decline in real after-tax income. The complexity of the tax code obscures what is happening. By the time a worker understands the mechanism, years of extraction have already occurred. Bracket creep represents the tax code on autopilot, generating revenue for government during inflationary periods without any political risk. The mechanism is documented in budget analyses, scoring reports, and revenue projections. The documents sit in public archives. The policy continues because most citizens never read them. Your tax rate is not what Congress set. Your tax rate is what inflation and frozen thresholds determine. The distinction matters more than most people realize. Everything described in this video is happening right now. The 2008 financial crisis triggered the largest expansion of central bank balance sheets in history. The Federal Reserve, whose holdings grew from approximately $800 billion to over $4 trillion by 2014. The COVID-19 pandemic drove another expansion, pushing the balance sheet above $9 trillion by 2022. This money creation was not stored in vaults. It entered the economy. It bid up asset prices. It began the inflationary process that exploded into public view in 2021 and 2022. Between 2021 and 2023, inflation in the United States exceeded the Federal Reserve's target by 2 to 5 times. Prices for food, energy, and housing rose at rates not seen in 40 years. Savings accounts paid near zero interest, while purchasing power evaporated at 7, 8, 9% annually. This is financial repression, the same mechanism that operated from 1945 to 1980. The International Monetary Fund has published papers discussing negative real interest rates as a debt management strategy. The language is academic. The meaning is clear. Governments with large debts benefit when inflation exceeds interest rates. The IMF analysis treats this as a policy option to be considered, not a violation to be condemned. Your savings account in 2022 earned perhaps 0.5% interest. Inflation ran above 8%. For every $1,000 you saved, you lost $75 of purchasing power. The bank statement showed growth. Reality showed loss. This is the silent tax, documented and operating in real time. Government debt in the United States exceeded $33 trillion by late 2023. The government benefits from every percentage point of inflation because it erodes the real value of this debt. Your loss is the Treasury's gain. The mechanisms are accelerating. Central bank digital currencies, or CBDCs, are under development in over 100 countries. The Federal Reserve studies digital dollar implementation. The European Central Bank advances the digital euro. China has already deployed the digital yuan in pilot programs. CBDCs offer governments capabilities that previous monetary systems did not provide. Programmable money allows central banks to set expiration dates on currency, forcing spending and preventing saving. Negative interest rates on cash holdings become enforceable when all money exists as digital entries. Capital controls can be implemented instantly, preventing citizens from moving wealth across borders or into alternative assets. The historical mechanisms described in this video required time and indirect pressure to extract wealth. Currency debasement took decades. Financial repression operated over 35 years. Bracket creep accumulated slowly. CBDCs compressed these timelines. A government facing fiscal pressure could implement immediate measures. Your digital dollars could lose value by programmed schedule. Your savings could face direct negative rates. Your ability to purchase certain goods, hold certain assets, or transfer money to certain recipients could be toggled off by central authority. This is not speculation. These capabilities are described in central bank research papers. The Bank for International Settlements has published analyses of programmable money features. The technology enables extraction methods Roman emperors and 20th century Treasury officials would have envied. The pattern across 2,000 years is consistent. Governments facing fiscal pressure find ways to extract wealth without visible taxation. They use control of currency as the primary mechanism. They benefit from complexity that obscures the transfer. They justify extraction through crisis language and appeals to stability. You are living through another chapter of this history. Your response to this knowledge determines whether you continue as a passive resource or become an informed actor. The systems described here are documented. The mechanisms are known. The beneficiaries are identified. Understanding does not stop the extraction, but it changes your relationship to it. You see the machinery. You identify the pressure points. You recognize the patterns as they repeat. The Romans debased their currency in secret, and citizens felt unexplained poverty. Roosevelt confiscated gold, and citizens received paper that lost value. Nixon closed the gold window, and citizens watched their dollars buy less each decade. Financial repression operated for decades, and citizens blamed bad luck for their stagnant savings. Bracket creep pushed families into higher tax rates, and citizens thanked their employers for raises that the government captured. Each generation learned these lessons too late. Each generation watched wealth flow from their accounts to government coffers through mechanisms they did not understand until afterward. You now understand beforehand. The documentation exists in archives, research papers, Federal Reserve records, Treasury memos, and CBO analyses. The patterns are established across centuries and continents. The current mechanisms are operating in real time on your savings, your income, and your purchasing power. What you do with this knowledge is your choice, but no one can say you were not warned. The financial tricks are not hidden. They are documented, they are continuous, and they are working on your wealth right now.